Good morning and welcome to this week's PFL podcast. I'm Brian Baker filling in for Curtis this week. We've got a lot to cover. Oil's war premium has fully unwound. Greenbrier gave us a fresh read on railcar leasing. And a brand new tank car story is taking shape around carbon. First, the markets. The Dow closed higher Thursday of last week and was up 595 points or 1.14% week over week. In overnight trading, Dow futures traded higher and are expected to open at 53,214 this morning, up 31 points from Thursday's close. Now crude. West Texas Intermediate closed up 11 cents to close at 68.69 per barrel, but down 54 cents week over week. WTI poised to open at 68.21, down 48 cents per barrel from Friday's close. In inventories, commercial crude drew down 3.8 million barrels to 408 million barrels. That leaves stock below the 5-year average and near historic lows for this time of year. Gasoline drew 2.3 million, distillate built 2.5 million, propane built 1.3 million and sits well above its 5-year average. Propane prices closed just under 70 cents a gallon, down 2 cents on the week. Rig counts were flat across North America. The U.S. added 7 rigs to 580. Canada shed 7 to 190 year over year. The continent is up 80 rigs. To the rails, North America volumes were up 6.1% in week 27 versus a year ago. Carloads rose 2.7%, intermodal jumped 9.7%. 8 of the AR's 11 categories were higher year over year. The other bucket led the gains. Motor vehicles and parts was the only laggard, down 4.2%. Now to what we're watching. Starting with Hormuz. The war premium is gone. WTI is back below $70. Flows through the strait have recovered past 10 million barrels a day. A 4-month supply scare has flipped to surplus, and with OPEC Plus ramping into reopening, the market is now price normalizing, not crisis. Over to Greenbrier. This is the one for fleet owners. Their fiscal third quarter showed the lease fleet up 23% from the prior quarter at 99% utilization. Tank cars and covered hoppers led the demand. The build side softened and backlog slipped. Management called 2026 the weakest year for North American delivery since 2010. A thin order book on top of near full utilization is exactly what keeps lease rates firm on the cars already out there. Turning to Ottawa, the Carney government referred Alberta's proposed 1 million barrel a day West Coast pipeline to the Major Projects Office. That's a striking reversal for a Liberal government, but there's still no private builder, no funding model, and no decision until October. For now, it reads more like press release than a project. On carbon by rail, a genuinely new demand category is forming. Union Pacific plans to haul captured CO2 from Midwest ethanol plants to Wyoming by late 2027. Greenbrier already has next-generation CO2 tank cars under construction. Overlay ethanol producers with the right geology, and BNSF, CP, and CN are all in line for the same traffic. For a fleet that has watched crude by rail shrink, may be worth watching. However, don't know who is going to pay for it. Those cars are very expensive and seems like a waste of money to us. Over to refineries. A fire at Monroe Energy's Trainer plant pulled a key Atlantic Coast refinery offline. Regional runs fell to their lowest since April 2025. That's the kind of setup that historically pulls Bakken barrels east by rail. What's capping it is a Jones Act waiver, which is letting foreign flag tankers move product up the coast instead. Closing out the watch list, U.S.-Mexico-Canada Free Trade Agreement, the administration declined to renew the agreement at its 6-year review. That kicks off annual reviews out of 2036. There's no immediate hit to freight, but autos, chemicals, steel, and ag are all core traffic. That's the report. PFL is your partner across the full slate: storage, leasing, and subleasing, car cleaning and repair, flaring, scrapping, nitrogen generation, and transloading. If you found this useful, please pass it along to a colleague.